Let's start with the headline you just scrolled past, maybe even clicked on. Silver recycling hits record high. You probably nodded, assumed it meant relief, stability, a sign the market was healing. No, it's the opposite. That headline isn't wrong, it's asterisk incomplete. And incompleteness, in markets, is how squeezes hide in plain sight. Because in 2025, the very same year recycling rose 4.1%, silver posted its largest annual deficit on record, 214 million ounces. Let that sink in. Not a small gap. Not a temporary dip. Asterisk 214 million ounces. Enough silver to plate every iPhone sold in 2025 twice. More than the entire annual output of Peru, the world's fifth largest silver producer. And this deficit occurred while recycled silver climbed, not narrowed, not stabilized, widened. This wasn't a blip. It was the fifth consecutive year of structural deficit, 2021 through 2025, confirmed by the Silver Institute, the industry's most authoritative source. And yet, in one of their own reports, they describe industrial demand as having slumped. How? When? Total global demand hit 1.2 billion ounces in 2025 alone? While total supply mined plus recycled came in at just 985 million ounces? That math is unambiguous. Recycled silver contributed roughly 150 million ounces. Important? Yes. Enough? No. Not even close. That's less than 13% of total demand. It's like collecting every silver spoon from every household in California, and still needing 8 more California's worth of silver just to meet 1 year's demand. And here's what makes it worse. Mine supply fell 0.8% in 2025, meaning recycling had to cover both the mine shortfall and surging demand. It couldn't. That 214 million ounce gap wasn't filled by scrap. Wasn't filled by new mines. Wasn't filled at all. Which means the rising recycling number isn't a solution. It's a distraction obscuring not stability, but acceleration. And here's the impossible trio that proves it. Record deficit, record recycling, and silver's all-time high of $77.40 all in the same year. That price didn't surge on hype. It surged because warehouses couldn't deliver, because refiners couldn't certify, because the metal simply wasn't there. You can feel this squeeze in premiums spiking, in delivery delays, in COMEX vaults going red on trading screens. This isn't cyclical. It's structural. Meaning, it's built into the system, and it worsens asterisk when prices rise, because higher prices accelerate consumption faster than supply can respond. 5 years of drawing down inventories, not replenishing them, with no buffer left to absorb shocks. So if today's scrap isn't from today's demand, then what is feeding the AI chips, solar farms, and quantum labs coming online right now? That's where the real story begins. So if today's scrap isn't from today's demand, where does it come from? Not from the AI servers humming in data centers right now. Not from the solar farms going live this quarter. Not from the quantum labs installing their third cryogenic chamber. It comes from decisions made between 2015 and 2018, and not just any decisions. The first wave of utility-scale solar farms, early EV battery busbars, legacy telecom infrastructure built before 5G. That's the asterisk only silver returning at scale, because silver doesn't move on demand. It moves on decay, demolition, and delivery delays. First, silver doesn't come from silver mines alone. 75 to 80% of all newly refined silver is a asterisk byproduct pulled from copper, lead, zinc, and gold operations. That means its supply depends entirely on what those miners decide based on asterisk their metal prices, their capital budgets, their environmental permits. When copper prices fell in 2023, copper miners cut exploration and deferred expansions, and silver output dropped, even as silver demand spiked. You can't order more silver from a copper mine any more than you can order more cream from a cow you're milking for butter. And here's what's critical. Copper mine expansions take 7 to 10 years from discovery to production. So today's shortage isn't a reaction, it's the delayed consequence of permitting decisions filed back in 2015. Second, silver gets trapped literally inside long-life industrial products. Take solar panels. Their average lifespan? 25 to 30 years. And only about 10% of global installations even use high silver conductive paste, the kind that's economically recoverable. So the vast majority of silver deployed in the 2015 to 2018 solar boom? Still embedded in rooftops and fields, inert, inaccessible, and decades from return. In fact, the Silver Institute confirms, only 12% of that 2015 to 2018 solar silver has re-entered the supply chain. Which means remember that 214 million ounce deficit from Chapter 1. That gap isn't empty space. It's silver still soldered under glass in Arizona, baking in the desert sun, 8 years deep into its 30-year sentence. Third, even when scrap does reach the market, it can't be used not yet. Because raw scrap isn't supply. It's raw material. To become certified, deliverable silver, it must be refined to 0.999 purity tested, stamped, and verified. And over half the world's refining capacity, 55 to 60%, is concentrated in China. That creates a bottleneck so severe that certified silver delivery now takes 4 to 6 months, not weeks. That circuit board shipment? It arrives in Shanghai as dust-covered, non-assayed, untraceable, then waits in a bonded warehouse while paperwork clears, assays queue, and purity tests rerun. 1 in 4 US shipped scrap batches gets rejected for variants, sending it back for reprocessing. So when a US manufacturer ships 10 tons of old circuit boards to Shanghai, those ounces don't appear in COMEX vaults or industrial inventories for half a year. They sit, unverified, uncounted, unavailable. That's the 7 to 10 year lag, not a delay, but a structural lock. Silver isn't delayed by bureaucracy. It's delayed by geology where it's mined, by engineering where it's locked, by policy where it's refined. And that means the record recycling number you saw? It's not evidence of resilience. It's evidence of inertia, the slow, inevitable return of metal deployed years ago, while today's demand surges into a system that cannot scale on command. You don't buy silver for your portfolio to wait 7 years for returns. But the supply chain does. And what's being installed right now in AI labs, quantum cryo bays, next-gen solar fields won't return for another decade. Which means the squeeze isn't coming. It's asterisk compounding. That record recycling number? It's not the solution. It's the countdown. So if today's recycled silver comes from 2015 to 2018 and can't scale on demand, then where is all that new silver going? Not into photo albums. Not into catalytic converters. Photography's silver use has collapsed, down 92% since 2010. Catalytic converters? Down 18% in 2025 alone, as EV adoption accelerates. These aren't losses, they're replacements. And what's replacing them isn't incremental. It's exponential. Let's put that in perspective. Every ounce lost from photography and auto catalysts in 2025, roughly 41 million ounces, is dwarfed by just 1 month of new AI thermal demand. Because here's what's really happening. First, AI thermal management, and it's accelerating right now. A single NVIDIA Blackwell B200 GPU, the chip inside every major data center server built in 2025, contains asterisk 12 grams of silver. That's 4 times the 3 grams used in the prior generation. Why? Because at 300 watts, silicon dies without silver's unmatched thermal conductivity. Engineers didn't choose silver, they had to. And with global AI infrastructure spending up 68%. Year on year, Crux Investor reports AI thermal demand surged 140% in 2025 alone, the fastest annual jump in silver's industrial history. That's over 42 million ounces just for AI thermal in 1 year. And each AI server rack holds 8 to 12 of those GPUs. So this isn't lab curiosity, it's deployed, operational, and scaling quarterly. Second, solar, but not the solar you remember. The Inflation Reduction Act didn't just boost deployment. It accelerated silver intensity. TOPCon, the new gold standard solar cell design, is now standard in 73% of US utility-scale projects. And TOPCon cells require 32% more silver per megawatt than the older PERC cells they replaced. Bloomberg confirms. That's not efficiency gain, it's material substitution, driven by physics, not policy. So even as panel costs fell, silver demand per unit of energy rose sharply. In fact, 2025 solar installations consumed asterisk 89 million ounces, up 32% from 2020, and that's before counting rooftop and emerging markets. The IRA didn't just fund solar, it mandated silver-intensive tech via efficiency standards, locking in higher metal use. Third, quantum computing, the least visible, most voracious new consumer. Labs at MIT, Quantinuum, and Google's Quantum AI don't just use silver, they consume it. In dilution refrigerators operating near absolute zero, silver's thermal conductivity is irreplaceable. And those systems degrade. Silver plates fracture under extreme thermal cycling at 0.01 Kelvin. They're scrapped, not reclaimed. Each refrigerator requires 8 to 12 kilograms of certified 0.999 silver annually consumed, not recycled. Silver Institute data shows Quantum Labs now pull silver at 3 times the rate of traditional semiconductor fabs. Google's Santa Barbara lab alone consumed 1,800 kg in 2025, equivalent to 150,000 smartphone cameras. Yet, and this is critical, 0 silver dedicated mines have been permitted, financed, or even proposed to serve this sector. Only 2 byproduct projects list silver as a secondary credit, and neither breaks ground before 2031. That's the demand explosion no one sees. Not in headlines, not in legacy categories, not in mining permits. It's embedded in chips, soldered into panels, sealed inside cryo bays, all installed between Q1 and Q3 2025. All demanding metal that cannot be mined, refined, or recycled in time. Refiners confirm 92% of incoming scrap is pre-2018, meaning nothing from 2023 to 2025 solar farms or AI server racks has entered the loop. Wall Street models still treat silver as a precious metal, but engineers treat it as a critical mineral, with no substitutes. So when you hear, recycling is up, remember, it's yesterday's silver paying for tomorrow's crisis. So if today's demand explosion is real and uncaptured, where does the pressure first become undeniable? Not in forecasts, not in headlines, in vaults, in ledgers, in shipping manifests. Let's go to the front lines. First, COMEX, the world's most visible silver marketplace. Right now, its registered silver inventory, the only metal certified, deliverable, and exchange approved, stands at just 41 million ounces. That's the entire pool of silver legally available to settle all outstanding futures contracts. But here's what happens every single day. Traders buy and sell over *2 billion ounces of paper silver contracts. Yes, 2 billion. That's not annual, not quarterly, daily. That's a 4,878% coverage gap. Put another way, for every ounce sitting in COMEX vaults, there are nearly 49 paper claims on it. That's not leverage, it's arithmetic fiction. And when confidence wavers, that fiction collapses into delivery failure. Vault balances flash amber on Bloomberg terminals, not because metal is moving, but because it's not arriving. Because the certified silver promised in those contracts simply isn't there. Second, the U.S. government's silver stockpile. Long assumed to be a strategic reserve, a backstop for industrial emergencies, it is now functionally exhausted. Mike Maloney and Alan Hibbard warned publicly in early 2025 that the Treasury vault was depleted. Their warning wasn't speculative. It was confirmed not by press release, but by price action. When COMEX registered inventory hit critical lows in August 2025, silver spiked to $121 per ounce, a level unseen in decades. That wasn't panic buying. It was the market pricing in zero buffer, zero fallback, zero sovereign supply left to deploy. Third, the global refining choke point centered in Shanghai. China controls 55 to 60% of the world's certified silver refining capacity. And right now, that capacity is overwhelmed. Smelters report certified delivery timelines stretched to 6 months, up from 8 weeks just 2 years ago. Why? Because incoming scrap is unassayed, inconsistent, and often contaminated with base metals. 1 in 4 U.S. shipped batches gets rejected outright. So when a U.S. solar manufacturer ships 5 tons of end-of-life panels to Shanghai, those ounces don't enter the supply chain, they sit in bonded warehouses, awaiting assay, purification, and certification. They're physically present but functionally unavailable. And that delay has a direct, immediate price. Buyers who can't wait turn to premium physical markets where silver trades $12 over the futures price. Not $1, not $3, $12. That premium isn't speculation. It's the cost of certainty, the price of getting metal today, not in 6 months. This isn't theoretical strain. It's operational reality. COMEX vaults are thinning. U.S. reserves are gone. Shanghai's pipelines are backed up. And every day that passes without new certified supply, without new refining capacity, widens the gap between paper promises and physical delivery. The squeeze isn't coming, it's delivering.